Hello guys, welcome back to my YouTube channel. And if you are not subscribed guys, what are you still waiting for? We have a lot of financial literacy information there that can help you start your investment journey. Our today's topic is unit trust. What are unit trust? How does unit trust operate? How can you start your journey of investment with the unit trust? So in simple terms, unit trust is just a type of investment where investors' money are pulled together and invested by a fund manager. And let's go to the classes or types of unit trust. The first type is money market fund, and I know most people have been talking about money market fund, money market fund. So let's deep and see what is a money market fund. How can you start your saving journey or investment journey with the money market fund? So money market fund, in simple term, is just a fund where money from different investors are collected or pulled together by a professional fund manager and invested in short-term investment. What are some types of short-term investment? Some types of short-term investment, we have treasury bill, we have certificate of deposit, and we also have commercial paper. Money market fund is the safest fund of all the four types of unit trust. Because the capital preservation is guaranteed, and it's the one giving highest amount of interest. It gives the highest amount of interest, at the same time is the safest. So if you want to start your journey of saving for a vacation, or you want to start your journey of investing for a certain goal, you can start your investment with money market fund because it's the safest. You won't lose your capital, and at the same time you will be earning high interest. So example of some money market fund in Kenya, we have Etika Money Market Fund, we have Saiton Money Market Fund, we have Zimele, we have Kuza. But before you invest in a particular money market fund, make sure you do a little research and know how that money market fund operates. Because out there we have some money market fund that doesn't charge deposit deposit fee. So some doesn't charge withdrawal fee, or some even doesn't charge deposit fee and withdrawal fee, so long as you withdraw once per month. If you withdraw more than once per month, then you will be charged a fee. So before you invest in any money market fund, make sure you do your research and know which one is the best money market fund for me, depending on your investment goals. Maybe you want to invest where you have high returns over a short period of time, or you want to invest in the stable money market fund where you will be earning low return but over a long period of time, for example 5 years or 10 years. It's up to you to choose which money market fund you want to invest with. But remember to do your research before investing in a money market fund, and enjoy those high returns offered by different types of money market fund. The second one is bond fund or fixed income funds. Their investment focus is in debt instruments such as government bonds and corporate bonds. Guys, they offer a diversified portfolio because they invest in various types of bonds. For example, you can find that they are investing in treasury bond, corporate bond. So you have a diversified portfolio of different types of bond. And don't forget, it has a higher risk compared to money market fund because the capital preservation is not guaranteed as with money market fund. And at the same time, it's offer you opportunity to invest in bonds with as low or as little as 5,000 Kenyan shillings. Imagine with 5,000 Kenyan shillings, you will be owning a bond, or you will be investing in bonds, compared to the bond offers in the CBK, where you are required to have at least 50,000 or 100,000 in order for you to invest in bonds. So you can take this opportunity. They are also safer because loaning a government, most of the government loans or the bonds are backed with taxes, and people will always pay taxes. But we are saying that they are risky because some of the money is invested in corporate bonds, and corporate bonds might default, or the company might collapse and you might lose your money. That's why we say for money market, for bond fund, they have a higher risk compared to money market fund. The third one we have equity fund. The focus of the investment is entirely on stock market. They invest in different type of shares, and at the same time they offer a higher returns compared to the remaining three funds. But at the same time, as you all know, the higher the risks, the higher the profit. So at the same time, it has the highest risks. So make sure before you invest in equity fund, you know your risk tolerance. If you are not a high risk tolerant person, then I'd rather advise you to invest in a money market fund or a bond fund, but not equity fund, because with equity fund you can obtain very high interest rates. You can get better returns, but at the same time it might cost you some of your capital if that particular stock that they invested in faces a financial crisis. So before you invest in a equity fund, make sure you also do your research. But with equity fund, you have no authority where your money is invested. The experienced fund manager will invest your money in those stocks that he knows best will give you a better returns. So also, if you want to invest in stock but you have no experience, equity fund offer the best platform for you. But at the same time, we can't ignore the risks involved, because stock market are always volatile, and I think everybody knows that. But with the experienced fund manager, he or she can help you to reduce that risk, because he will be investing in whatever he knows perfect, or something that he knows very well. So the last but not the least, we have a balance fund. With the balance fund, your money is invested both in stock and bonds. And the better thing with the balance fund, it offer a diversification of both. It's offer a diversification, because it invests both on stocks, and it invests also in bonds. Sometimes you might find the 50% is invested in stock, 50% is invested in bonds, or 75% is invested in bonds, and 25% is invested in stock, and vice versa. So you don't have to worry a lot. And the risk tolerance, I can say it has a medium risk tolerance for those who want to invest in a balance fund, because your money is not entirely invested in stock. But bond fund provide a better risk tolerance than a balance fund. But a balance fund, if a balance fund will provide you with a better returns compared to fixed income fund or bond fund. But at the same time, it have a higher risk compared to money market fund and balance fund. But it's better if you don't have that high risk tolerance, it's better for you than investing in equity fund. But remember, the higher the risks, the higher the returns. Guys, if you have not subscribed to my YouTube channel, I don't know what you are still waiting for. Kindly subscribe to my YouTube channel, share the content with your fellow colleagues, so that all the youth can have this financial literacy to start their journey of investment.